There's a massive change coming to the way pensions are taxed when someone passes away. From the 6th of April 2027, unused defined contribution pensions, the very pots people have been told for years are exempt from inheritance tax, will be bought inside your estate for inheritance tax purposes. This was proposed in the autumn budget in 2024, and the government has since published draft legislation confirming how the rules will work. And for many families, this change could increase their inheritance tax bill by hundreds of thousands of pounds. I'm Henry Rutherford, a chartered financial planner, and today I'm breaking down exactly what's changing, who's affected, and the planning options you may want to consider before the new rules go live. Before we get into it, just a quick disclaimer. This video is not financial advice, but simply education to promote some key topics which you may need advice on. If there are any topics which may apply to you, reach out to me through the link in the description or speak with your local financial planner. To understand why this matters, let's quickly recap the inheritance tax system. In the UK, inheritance tax is charged at 40% on the value of someone's estate above their available allowances. Most people will have a £325,000 allowance, which is called the nil rate band, and then potentially an additional residence allowance of up to £175,000 if a main home is passed to direct descendants. Just to add here, if your estate exceeds £2 million, that residence allowance reduces by £1 for every £2 over the threshold, completely disappearing for estates over £2.35 million for individuals. So not everyone gets the full £500,000 or £1 million allowances. At the top end though, that gives an individual a total allowance of up to £500,000 or up to £1 million for a married couple or civil partners. Anything above these allowances is taxed at 40%. That means with a joint allowance, an estate of 1.5 million could face a £200,000 tax bill, or a £2 million estate could face around about £400,000 in tax. Until now, pensions have been one of the most inheritance tax efficient assets you can own. Under the existing rules, pensions sit entirely outside of your estate for inheritance tax. If you die before the age of 75, the pension passes to beneficiaries tax-free. If you die after 75, they pay income tax when they withdraw it, but still no inheritance tax. This has shaped decades of retirement and estate planning. For example, imagine someone with a £1 million house, £300,000 in ISAs, £200,000 in savings and a £500,000 SIP. For inheritance tax, only £1.5 million is counted. The pension is ignored entirely. That's the rule that's now changing. So here's the part that really matters. In the autumn budget in 2024, the government announced that from the 6th of April 2027, most unused pension funds and pension death benefits will be brought into scope for inheritance tax. This is not speculation, it's confirmed policy direction, and the draft legislation was published on the 21st of July 2025. Under the new rules, unused defined contribution pension funds will form part of the deceased estate for inheritance tax purposes, and there are some refinements. Death in service payments from registered pension schemes will be excluded from inheritance tax. Responsibility for reporting and paying the inheritance tax will fall to the personal representatives, not the pension administrators. But the core change remains. Pensions will be assessed for inheritance tax. HMRC estimate that about 10,500 estates that currently pay no inheritance tax will begin paying it under these rules. And around 38,500 estates that already paid inheritance tax will now pay more, in many cases significantly more. So let's look at how this plays out. Take a joint estate worth £2 million, which is made up of a £1 million property, £300,000 in ISAs, £200,000 in savings, and £500,000 in a pension. Before April 2027, only the 1.5 million of that £2 million estate outside of the pension is counted. Assuming all exemptions are available, taxed at 40%, that is a £200,000 inheritance tax bill. After April 2027, the same scenario and the entire £2 million is included. Taxed at 40%, that £200,000 becomes a £400,000 bill. That's an additional £200,000 in tax purely because the pension is now included. This is why so many families need to revisit their planning. The people most exposed to this change are the ones who have followed the existing rules perfectly. Retirees who have deliberately left their pensions untouched, business owners with large SIPs built through decades of contributions, and families who intend to pass pensions directly to children or grandchildren because it was previously one of the most tax-efficient methods available. These are the people who need to take a fresh look at their planning. So what can people do? Let's be clear, none of these strategies are about reacting to unconfirmed ideas. They all work under today's rules, regardless of what happens in 2027, but they can also help reduce the impact of the changes when they arrive. First and foremost, spend your money and enjoy it, but in a controlled manner that doesn't result in a shortfall later in life. Advisors use cash flow modelling to help build out that forecast, considering stress points and the unknowns that may need to be catered for. But also lifetime gifting more proactively. People often underestimate how much they can gift each year without creating inheritance tax complications. When someone has more pension income than they need, drawing a little extra and gifting the surplus can gradually reduce the taxable estate. There are rules around how to do this effectively, so please speak with your accountant in order to make that qualified. Another option is the use of trusts. If pension withdrawals are simply left in a bank account, they remain part of the estate. A trust allows you to ring-fence assets, control how they're used, and pass wealth on in a structured way. Trusts are not simple. You need proper advice, but used correctly, they're extremely effective. And then there's life insurance written into trust. This is one of the cleanest solutions available. The policy is outside of your estate from day one, pays directly to your trust and the beneficiaries, and gives them the cash they need to meet the inheritance tax bill. So here's the bottom line. This is one of the most significant tax changes to pensions in a generation. From April 2027, the rules change. Your pension, something you've built over decades, may now fall into your inheritance tax calculation. And the biggest mistake you can make is doing nothing. If you want personalised advice, speak to a qualified financial planner who can look at your full situation, your pensions, your estate, your family structure, and your long-term goals. A conversation now could save your family a six-figure tax bill later. If you want more clear, practical breakdowns of UK pensions and tax changes, hit subscribe and turn on the notifications. I release new content every week to help you make more confident, informed decisions before the rules shift, not after. Thanks for watching. I'll see you in the next one.